Hey guys, happy 2019. I want to spend a few minutes talking about what's happening in the global economy. If you've been a client for a while, you've probably heard me talk about mean reversion. It's a term I use a lot. In 2017, we had exceptionally low volatility. It seemed like most days the market would go up 0.5%, and then there'd be the odd day where it would go down 0.25%. That was ideal. 2018, completely different story. We had exceptionally high volatility, thus reverting to the mean. Traditionally, we see tradable markets swing too far, both up and down based on both fear and exuberance. So buckle up this year. Let's kick off this review right here at home with an update on what's happening in the United States. Domestic growth is slowing. I know, shocking. Employment data has been really solid, but we're starting to see a bit of a demographic crisis. Essentially, this means we're running out of workers. More highly skilled jobs are available than highly skilled workers are available to take those jobs. Participation rates are still not as high as they could be, which is definitely contributing to the problem. Back in 2008, right at the beginning of the recession or just before the recession, we saw the participation rate in excess of 66%. This chart that's on your screen shows how it's been steadily declining over time, all the way to today where we're just below 63%. This effectively reduces the ability for corporations to increase their top-line growth, especially because they're maxed out on their per-employee productivity levels. Next up is consumer confidence here in the United States. This is a leading indicator. CCI is based on how people are feeling about the economy, which determines how people consume goods and services in the near future. 70% of our GDP is from domestic consumption. That's you and me going out and spending money on restaurants and buying iPhones. On this chart, anything above 100 is good. It indicates the consumers are optimistic and they're a little bit more likely to spend than save their money. Anything below 100, people are pessimistic and more likely to save than spend. Inflation is another issue that's been all over the news. People can't seem to decide if we're dealing with inflation problems or if we have deflationary issues in the economy. I'd argue that we are bordering on what's called a stagflationary environment. This is when prices of consumables increase while the economy is slowing. This is rare in the United States because it's not common for asset prices to increase and the economy to slow down. Normally, the economy increases as a result of asset prices increasing. At least in the last leg of bull markets, this is common. Driven by timing and size of Fed decisions, coupled with fiscal policy coming out of the Capitol. Essentially, we're currently in a deflationary environment being exacerbated by Fed policy. But we have inflationary fiscal policy. This creates overpriced securities to which we're seeing a price adjustment just recently over the last few months. The market is now definitely healthier than it was 6 months ago. Next up is housing. We're experiencing a sequential slowdown in housing markets from artificially inflated prices. It's obvious that people were inflating home prices because of incredibly low interest rates on mortgages. Home builders have been slow to catch up with demand, and greed has caused excessive supply at the high end of the market. Take a quick look at this chart. Supply is still well below average for low to intermediate housing. This is obviously a problem, especially for the millennials that are out there looking to buy their first home. Not only can they not afford rent because rent is up at record high levels, there's just not enough entry-level houses for them to buy. Moving outside our borders, I want to briefly touch on a few points in the international markets. Growth is slowing. It's been happening for a while. It's primarily driven by geopolitical uncertainty. A great example of this is what's happening with the Brexit negotiations. There's a lot of policy confusion in developed Europe. For the first time, the EU is facing multiple countries that have provided draft budgets that are not compliant with the requirements of the Stability and Growth Pact. They're considering allowing these budgets to slide for just 1 year, with the hope that the countries will stabilize to the point where they can provide a compliant budget in 2019. This will obviously cause problems when not all members of the EU are playing by the same set of rules. Moving over to one of my favorite indicators, the Purchasing Managers Index, or PMI, in the EU. It provides current information about business conditions. On this chart, if you see PMI over 50, that's solid because it shows confidence in the manufacturing and service sectors, which are major drivers of GDP in the European Union. Anything under 50 is not good. It means things are slowing down. Moving over to Southeast Asia, Africa, and down to South America, we have some serious currency headwinds. This has absolutely everything to do with the US dollar. When the dollar strengthens, emerging markets can't refinance debt, and it becomes harder to pay interest as their currency is less valuable. It makes consumables more expensive because almost all of them are denominated in US dollars. Governments issue debt in US dollars. The dollar strengthens, local currency is weaker, but outstanding government debt is the same amount denominated in dollars. Therefore, it's more expensive to service the debt, leaving less to put into their own economy. This strains the people, especially because consumable prices remain constant when denominated in dollars. Thus, their economies must slow down. The China trade war is another major issue that we're seeing. China began to make concessions in the form of commitments to purchase additional U.S. goods to narrow the import-export gap. On the surface, this is favorable, but unfortunately, they're finding other ways to damage U.S. business interests. A great example is them stalling U.S. perishable goods shipments at Chinese ports for bogus reasons. Just recently, we had a $50 million shipment of cherries from U.S. farmers rot on Chinese ports. The Chinese companies that ordered those cherries refused to pay for them because they said they delivered rotted goods. Another way that China is making a concession in this trade war is they're offering to reduce tariffs on auto imports. This is actually irrelevant because they require a certain portion of cars for every manufacturer to be made in China. This has just driven U.S. auto builders to simply build their cars in China. That way, they don't have to deal with tariffs in the first place. China hasn't agreed to materially change their practices of IP theft. Stay tuned on that one. On the bright side, we do have a temporary moratorium on imposing additional tariffs. This will provide us a little more time to negotiate and hopefully come to a middle ground. Next up on the list is oil prices. Prices have collapsed in the last quarter. Why? Too much supply. Fortunately, demand is increasing too. It's just not increasing fast enough. What's really interesting is most of this oversupply is driven by U.S. shale producers. Their production has been way beyond expectations. World producers, primarily OPEC and Russia, have agreed to cut supply in 2019, which should provide a floor for oil prices. It remains to be seen, though. The last item I'd like to discuss is potential Fed policy. This has been all over the news. If you're following CNBC on a regular basis, they talk about it every single day. Essentially, the Fed has been raising rates for 2 years. They have two jobs. Their two mandates are to create full employment, which we're basically at right now, and to try to maintain inflation around 2%. The policy in the recent years has created a very, very strong dollar because as the Fed raises rates, the dollar strengthens. If the Fed caves to pressure from the administration and starts to focus on security prices, which are certainly not their mandate, they may stop increasing interest rates, which would halt the increase in the dollar. The only short-term bright side to that is it would probably create another leg higher for U.S. markets. I'd like to close with discussing general positioning in your portfolios this year. The point I want to drive home first is that data will dictate the positioning. Over the next 3 to 6 months, I intend to focus on high-quality, lower beta domestic equity exposure. We're going to have a slight overweight to fixed income and alternatives, and our international and emerging markets exposure will remain about unchanged. It's important to note that all of this will be based on your individual risk tolerance and asset allocation. These are just general overweights and underweights that we'll be utilizing across the board. I really appreciate you all watching this video, and please don't hesitate to reach out if you'd like to discuss any of this in further detail. Have a healthy and prosperous 2019.